Well, the Fed hiked as expected, but they postponed the pivot. Hey, it's Eric Osnes here with Homebridge Financial Home Mortgage with my weekly update on mortgage rates and the economy for the week ending November 4th, 2022. Well, the Fed did hike their rates 0.75% this week as expected. Mortgage bonds initially rallied, mainly because the hike was already anticipated and cooked into today's mortgage rates. But the traders are really hoping for a softening tone from the Fed in anticipation of a slowing economy. That didn't happen. Chairman Powell's comments after the hike remained hawkish, which was not good news for interest rates. A different story behind the jobs headlines we just received for the month of October. October's non-farm payroll statistics beat expectations, growing by 266,000 against a forecast of 200,000. But the household survey, which includes 60,000 phone calls, interview surveys, and I consider it much more reliable, showed a much weaker picture. In it, job losses were at 328,000, and prime earners, those aged 45 to 54, were hit the hardest with job losses of 406,000. It appears that job creations were mostly in the lower paying leisure and hospitality sector, and also a lot of seasonal hires for the holidays. Overall, the labor force contracted by 22,000, and the unemployment rate increased to 3.7% from 3.5%. These are signs of a slowing economy, so we need a few more months of these statistics before we'll see mortgage rates really start to respond to that. But cross your fingers. For the week, mortgage rates did increase. They started to look a little bit better, though, as of this writing and this recording. Here are the national averages. Conventional 30-year fixed rate, 7.29%. That's up about 0.21 from last week. 15-year fixed rates, 6.75%. That's up 0.25% from last week. 30-year FHA and VA, 6.84%. That's up about 0.22 from last week. And 30-year fixed rate jumbo, 6.35%. That's up about 0.26% from last week. Also, another thought on interest rates. Are we going to have a midterm miracle? I try not to discuss politics in this publication in my weekly updates, especially, but it's impossible to ignore the potential impacts of next week's midterm elections on the financial markets. I recently came across a very thought-provoking article by a very renowned fund manager regarding midterm elections. The financial markets goes like this. The financial markets prefer neither party. They dislike extremes. In short, they like gridlock. Gridlock blocks extreme legislation that can complicate business planning and investment. That's important for interest rates. Gridlock does not mean that nothing passes, though. Instead, it means that what does pass is generally not very controversial because it requires bipartisan agreement. Such legislation is less likely to create winners and losers sufficient to have the losers hating it more than the winners like it. There's strong statistical evidence showing market gains following gridlock producing midterms. So next week is going to be important for the financial markets, not only because of the midterms, but also we will be getting CPI data, the consumer price indexes for October. These are both going to be significant market movers. So be sure to check back in for the rundown next week. And be sure to vote. Super important this time around, especially. I'm always here available to answer questions. You can reach me directly. Call me 206-915-3742. That's 206-915-ERIC. You can email me, eric@ericismybanker.com, or look for me on social media. Just search out Eric is my banker and be sure to subscribe to my weekly updates. That's all I've got for this week. I hope you have a great weekend. Talk to you next week.